Hey everyone, welcome back to This Week in Markets. Today we're chatting with Dave Skarica on the subject of equities. Dave is the publisher of AddictedToProfits.net, the Addicted to Profits newsletter. Dave, how you doing today?
I'm doing pretty good. How are you, Jordan?
I'm pretty good. Let's first things first. I know a week or so ago we spoke about the equity market in the U.S., so I don't think we need a drawn-out answer here, Dave. But you recently wrote something that's published on DougShort.com, also AdvisorPerspectives.com, and we'll link to that. And the title of your piece is "Why the Market is Doomed," and we're not talking about a real doomsday scenario here, Dave. But why don't you just let us know why you think the market is, at these levels at least, is doomed right now?
I think I had just seen a Mark Faber interview right before I wrote that letter, so I was kind of in that mode of the doom and boom kind of theme. I think part of the reason is this. Number one, on the macro secular cycle, I think we're still in a bear market cycle for stocks. I know people can see at the S&P at new all-time highs, the Dow at new all-time highs, and say, Dave, how you can think that. But what's interesting, if you go back and look at a chart of the S&P during the 70s, the 1980 high in the S&P was about 140, which was about 50% higher than the 1966 secular inflation-adjusted high. So you can hit new higher highs, especially when you've had a lot of inflation. And but what it really is that go look at the ascent of decline from 1966 to 1980 compared to the ascent of decline from 1982 to 2000s. It's much more choppy. It's much more sideways. And of course, at the bottom of the market in 1982, the S&P was barely where it was in 1966 at the high, and the Dow was actually about 20% lower its 1966 high. So this is where I think we are. I think this is a false rally, much like the 74 to 76 rally, much like the 68 to 70 rally. Much like the 2002 to 2007 rally. I think this is just a false kind of bull market, and then at some point we're going to turn around and go lower. So one thing I talk about in the article is, that's my secular view, that forget all the fundamentals. I think we're still in this 15 to 20 year bear market for stocks, which means that we'd have another anywhere 2 to 7 years left in this secular bear market. So number one is corporate profits and profit margins. They're about 10% right now, which is an all-time high. The previous highs were in 1998, 99 when they got to about 8%, and in 2006 to 2007 when they got to 9%. And of course, none of those recent spikes in corporate profit margins were sustainable, and big bear markets followed in each case. And part of the reason that they're high is that if you look at junk bond and AAA bond yields, the AAA bond yield right now on like an average 1 year bond in the corporate bond market is about 2%. Well, historically, you're talking 5 to 6% is the average. So that kind of 4% between the historical average and now, that adds to the bottom line and artificially inflates corporate profit margins. Like, for example, even on higher yield corporate bonds, the yield on them actually spiked to over 20% on the Merrill Lynch high yield index during the financial crisis, which was still high. But typically, these yield 10, 12%. They're down to just over 5% right now. So again, that lower interest expense helps companies' bottom lines, and it's all unsustainable. So what then you've had like this move into McDonald's and Walmart and J&J, and it's kind of the opposite where we were in 2000, where all these internet companies which had no profits or no anything, they're all going into them. Like everybody was going into them, and then now you got everybody going into these large cap blue chips because they're desperate for yield. And I guess they've been burned in bubbles, so they think these stocks can't be a bubble just because they have real earnings and profits. So that is another reason that those companies are all overextended. I can't see them going a lot higher. And then we just have sentiment. If you look at Investors Intelligence, you look at the RIDEX asset ratio, which shows where money managers are actually putting their money. These things are all showing bullish blow-offs that they saw. Actually, the RIDEX ratio saw its highest bullish readings, which is bearish for the market since the 2000 bubble top. So this just shows that people are just getting one-sided in their psychology, and then the valuation. The 10-year trailing on the S&P, the cyclical P/E is over 20 times earnings, so we're not cheap anymore. We never got to below the 10 times earnings that you need to see, like we saw in 74 and 82 in the late 40s, to start a secular bull market in stocks. So I think right now we're just kind of setting ourselves up for another intermediate to semi-long-term high. I don't know, because our last two bear markets are each like 40 to 50%, and I don't think we've ever seen three 40 to 50% declines within, say, a 15-year period. So I think this could be the inflation bear market, where the nominal drop is, say, only in the 30 to 40% range, but because we're seeing higher inflation, we're seeing it drop another 50% in inflation-adjusted terms. And the last interesting point on that is this. This is the first time, maybe since the early 2000s, the 2000 2002 or 2003 bear market, was where commodities moved higher really through 01, 02, and equities lower, that we're seeing a very negative sentiment towards commodities and a very positive sentiment towards stocks. So this is the first time, and especially negative sentiment towards gold and positive sentiment towards stocks, we're seeing them diverge. So I think we really could see a stagflationary kind of bear market where commodities and especially precious metals go up in price, and the equity markets move down in price. And I think we're seeing that. Like, I know gold and the markets were up a lot on Thursday together, but we're definitely seeing this recently, where you've seen actually gold trading higher on days where the market's trading lower, and we saw the vice versa that really since the middle of last year. So I think we're now seeing this interesting thing where gold can trade higher in the market lower. And just a quick note, I talked about 74 to 76. What's really interesting is gold right now is tracking the 74 to 76 bear market in gold almost exactly. And what's interesting about that is gold bottomed in August of 76, and the stock market topped in December of 76. So it was about a 4-month lag. So if gold bottomed last month, that could be telling us that maybe we see a summer to fall peak in the stock market.
Yeah, perhaps October, which is typical time for the market to peak.
No, it's actually a typical time for it to bottom. But
perhaps September. A lot of big sell-offs begin in September.
Into October, yeah. But remember, the 2007 top happened in October. And one reason that I didn't turn bearish enough in 2008 was I just never seen a market top in October. So I guess that could happen again. But I would look more at kind of the top. Topping is a process. And in each case, in 2000 and 2007, 2008, we took 3 to 6 months to top out. Now, I don't know if we'll take that long again, but I would definitely look at least a few weeks to a few months in terms of topping out. In terms of the market right now, in terms of this topping process, if we top kind of here and correct and then go back up and we start building this top, yeah, it could be a 3 to 6 month process. If we just kind of pull back here and we see, say, the S&P then rocket to 17 or 1800, I would be much more worried that we are going to see a crash type scenario where we can see a very swift decline. Say we go to 1800, right back to 1400 or something like that, like in a quick time frame, because we're going to be going too parabolic on the chart if that happens. So I would kind of be worried about that. I don't think that's going to happen. I actually think we're starting the topping process right now. You're seeing a lot of distribution. You're seeing a lot of days when people want more money printing or weak economic activity comes out and they think, oh, this means the Fed's going to keep printing. We're seeing a lot of this coinciding with like gaps up. Like today, like on Thursday, the Dow was up well over 150 in the morning and finished up 20. So I think we're seeing a lot of that, and that usually is distribution and is kind of a sign of a topping pattern. And just to go into gold stocks being the opposite is after you have a crash, what gold stocks had. I did this interesting study recently where I was looking at 87. I was looking at, the 2008 crash in gold stocks. as well. There's like a 2 to 3 month period where the gold, where after a crash, the market will base out and then break out and begin to move higher. And we're actually already a month and a half into that for gold stocks, which would tell me we only have about a month to month and a half, stay at these low 250 to 300 level on the HUI, and then hopefully over the second half of the year, really begin to move higher.
Okay, Dave, let's so you've covered the S&P here. You touched on the gold stocks a little bit. So I take it that you do like the gold stocks. So aside from the market at large, meaning the S&P 500, what particular equity sectors look interesting to you right now?
Well, what's interesting about this bull market as opposed to 2007, 2008, when everything kind of took off, is like, for example, a lot of these alternative energy sectors, the solar stocks, the wind stocks, they all had huge spike runs in 2008 and were part of the bubble along with housing and the whatnot back then, in a mini bubble in commodities. Now they all collapsed because there's a huge glut in the solar market and because the energy prices came back and there wasn't much competition and everyone's obsessed with this fracking boom in the States. So I like kind of some of these alternative energies, and I'm going right into the heart of the negativity. The European Union and the U.S. both put tariffs on Chinese solar panels. And I actually like the Chinese solar and wind companies because that's where the maximum pessimism is. A lot of these are down. They look like the banks back in 2009. A lot of these are down 90, 95%. And an interesting thing about that is if you're down 95%, you've gone from 20 to 1. You only need a rebound back to 2 for a 100% gain. So it's just mathematics. And I think a lot of the solar companies in China are being treated like the banks were in 2009 in the States, where the Chinese government's putting money into them. They're buying assets at overinflated levels. Essentially, you're seeing the banks bail these guys out. So that's what I'm kind of looking at here in China. They're going to bail these solar companies out. I just found a Chinese wind company looks fantastic on the charts right now, and I think they're a really good bottom feeding place. I really like the coal stocks. They're also really beat up, and in coal, a lot of the emerging markets doesn't have the problems that it does in the merged world. In the first world, in terms of regulations and environmental regulations, because a lot of emerging markets just want power, they just want energy. And then finally, I actually like a lot of the tanking and shipping stocks. I know that like saying that I think the U.S. economy is topping means that you might think there'll be a downturn in economic activity, but if you kind of think the opposite, that maybe China and India's economic activity is bottoming, they would make sense too. And same kind of thing. These stocks are off 80, 90%. A lot of them pay good dividends. So that's what I find interesting right now about the market, is that there's all of these sectors that are totally beat up, despite the fact the U.S. stock market's gone up. Like for example, you look at Europe, the consumer confidence readings in Europe is exact opposite the States, where the U.S. is making multi-year highs, the European consumer confidence is making multi-year lows. So why can't, and this will get to my last markets I like, why can't the markets in Europe, especially on the periphery in the pink countries, why can't these markets rally even if the U.S. has a bear market? Because the U.S. having a bull market didn't help them. Italy and Spain and Greece and all these countries are still much closer to their all-time lows than they are, or multi-year lows than they are all-time highs. So I would look at selective stocks in those countries. There's actually a media company in Europe I really like right now as well, which is another kind of maximum pessimism turnaround play. So those are basically it. On top of, I know you talk about a lot in gold and precious metals. I do like the junior sector a lot. I think it's really beat up and bottoming and that sort of thing. So I would say, yeah, like I said, I like coal. I like solar. I like some of the shipping companies, and I'd like certain stocks and markets in Europe, which has kind of like been the heart of weakness in worldwide.
Dave, let me get your thoughts on China, because if you look at the Shanghai Composite, I don't know if you can bring it up there on your screen as I'm talking, but we've seen some positive activity there. It looks like the market bottomed at the very end of last year and looks like it's made a higher low. Of course, negative sentiment on China is very, very high. Um, we're starting to see rate cuts all around the emerging world. But I just want to get your thoughts on China, Dave, because in the past you've pointed out that there's not always a strong link between the Chinese stock market and the economy. I mean, the stock market didn't do much for a while when the economy was really roaring. So the fact that the Chinese market is perking up a little bit, can we read anything into that? Is it a good sign for commodities, or can we just not read much into that?
I don't know if you can read that much into it because again, I always point out from the early 2000s to the mid 2000s, before it really spiked up in the last move of the bull market, the Chinese stock market lost 50% of its value, even while the economy was growing at 9 or 10% a year. So I don't know if we can take that much into it, but I think when you look at the Chinese stock market and it being off almost 65% from its all-time high, that yeah, at some point it's going to kind of bottom here and probably turn around. And even if the Chinese economy continues to slow and you continue to see kind of this problem in housing, I don't really know the market's going to reflect that. And like you just mentioned, the market actually looks like it's actually somewhat turned around and could begin to rally here. And yeah, maybe that is anticipating a turnaround in the Chinese economy or a little rebound in the Chinese economy as well. I think that again, selective sectors in China, like I said, I like the solar sector just because it's so beat up there, and I just think that all the bad news is priced in. The U.S. has put up tariffs, Europe has put up tariffs, and if one of those two regions, and Merkel was already talking about with the Chinese leaders how she doesn't want these tariffs to really stay on them. If one of those regions lifts the tariffs, that also obviously boosts those stocks a lot. So I just think that certain sectors in China, yeah, are very, very appealing and will do quite well going forward here. Like for example, this wind company I found out of China, it looks absolutely phenomenal. Like it's put together a huge base over the last year.
Okay, Dave. So before we close here, just summing up what you've said today, essentially we kind of have a divergence between the broad market and especially precious metals, but you can also say there's a divergence between the broad market and commodity sectors. So, and in addition to that, you like select sectors, which you've already mentioned. Is that fair to say what your thoughts
Yeah, I
are
like
here?
select sectors. And a quick note about the US dollar. Now, I know we have seen weakness in the Canadian and Aussie dollars and commodity based currencies, but if you take a look at it, the euro last December was trading at $1.30. It's now trading at $1.30. It hasn't really gone anywhere. And that's the majority of the US dollar index. A lot of the dollar index rally, and this is why I don't take the breakout that seriously, is this huge drop we've seen in the yen. So, basically, even if the yen does ultimately drop another 10 or 20%, it's probably going to somewhat stabilize here around 100, around 100 to 102, and that is probably going to turn around and maybe cause the dollar to drop here, which also could help commodities and commodity stocks. So I would look at, you have to take that U.S. dollar rally with a grain of salt because you just saw a 30% devaluation in a major currency, and in all probability, that Japanese yen has not fallen another 30% in the next couple of months. It may do it over the next 5 years, but it's not going to do it in the next month or two. So I would also take that into account to really help some of the commodity stocks as well going forward. But you're right. That's basically my thesis right now. I think the market's topping. Let's start topping. Gold is bottoming. And I like selective stocks in China and Europe, and obviously even the U.S. markets. I like the coal and shipping companies as well. So yeah, I would say that's my basic philosophy right now.
All right, Dave. Well, on that note, thanks so much for joining us today. And why don't you tell all of our listeners how they can find your website?
Yeah, if you go to addictedtoprofits.net, sign up for my free newsletter. I'm just about to post this recent article that was posted on D-Short. And I think you'll find it is a good overview, and I present my argument of why I think the market is topping. So check that out, and that's kind of indicative of the kind of work I do.
All right, buddy. Thanks so much for joining us here today. I really appreciate it, and we'll have you back again soon.
Okay, talk to you later.